Good morning to all of you.
Morning, sir.
Morning.
Morning too. Okay, so yesterday, we did finish on the topic on financial market and financial institution, and we agreed that today we are going to start off with a new topic. But before we do that, okay, of course, we need to check out the examiner. We see how the question from this particular topic may be answered. So I want us now we go through our question bank. We see how the examiner, what's the way the examiner can ask question from this particular topic. Okay, so let me open my question bank as you also do the same. We go through the examiner, the past paper the examiner has asked in this particular area. Okay.
Current assets plus current liabilities.
Sorry, current assets?
Minus current liabilities.
Current assets minus current liability. That is true. Thank you. Current assets minus current liability is what referred to as the net working capital. Okay. What referred to as the net working capital. The current assets, the excess of current assets over current liability is what referred to as the working capital. Okay. So which means therefore, working capital is what makes up current assets and what makes up current liability. There was constraint. What makes up current assets? We have cash, okay, we have receivables, we have inventory, we have money market instruments, okay, or money market securities, which I think you discussed already. We have prepayments, okay, and many others. In the case of current liability, we have, for example, trade payables. Okay, we have accruals. We have what else? Short-term loans and overdraft. Okay. So all the mix there for the current liability. Okay. So therefore, when it comes to working capital management, okay, what you're doing is the management of the components of the working capital, the component of current assets and the component of current liabilities. Okay. Now, in this topic, we are not going to discuss all this. Okay. We shall discuss how do we manage cash. Okay. How do we manage receivable and how do we manage inventory. Okay. As well as how do you manage therefore a trade payable. Okay. So we're going to further split this topic into four subtopics. Okay. We discuss cash management, inventory management. We discuss on the receivables management, and we discuss on the trade payable management. Okay, so those we shall be discussing in detail the management of each of those components. So into four subtopics. Okay. Now we go back. Why do we need to manage these components? Why do you need to manage cash? Why do you need to manage receivable? Why do you need to manage payable? What's the objective? What's the purpose? There are two key goals, okay, or purpose of managed working capital. So the purpose of managed working capital is two. One is to make profit, of course, or you're a commercial company. And two is to be able to remain liquidity objective. So that means, therefore, as a company, you are pursuing, you want to ensure that whatever investment you're making, because this working capital is an investment, okay? If we buy inventory, that inventory need to drive our profit. If it does not drive a profit, then why do we need to invest our money there, okay? So we need to see that we are going to making positive returns on the investment we are making towards the working capital, okay, to make profit, okay? Then, of course, we have a case of liquidity. Okay, we want to ensure that as we do manage the receivable, we do manage the key component of working capital. We also going to pay attention to the liquidity. What's liquidity? Liquidity is the chance that you can be able, okay, to pay for the obligations, okay, as and when they fall due. Okay, do you have an obligation? Yes. Okay, can you honor that obligation? Your task case of market. Can you pay your creditors? You may not. Okay? You don't have enough cash, for example. It means therefore it can be deemed to be illiquid. Therefore, okay. So that's called liquidity. Okay, can you be able to pay for the obligations as and when they fall due? Okay. Now those are the two objectives. When it comes to investing towards inventory, pay attention. This inventory investment I'm going to make, I'm going to be spending 10 million. What's the impact it has on my cash position? Okay, consider what's the impact this investment on company liquidity. Okay, they're the two key objectives. So when managing the different components, managing cash, managing in receivable, inventory, payable, we pay attention to those two key objectives of making profit, making positive returns, as well as being able to achieve liquidity. Okay. So the two key purposes of manual photo. Each one of them, don't forget that none of those two goals, okay, is in quote better than the other. Okay, they're all two objectives which you need to pursue as a company. Okay, to make profit and of course to be able to pay for the obligations as and when they do fall due. Okay. Now, at the end of the day, it was enough you make an evaluation. Okay, how effective, how well has the management of this company been able to achieve those two objectives? Okay, so you're going to be basically evaluating or evaluation or means of trying to make an evaluation of the working capital management efficiency. Okay, you're going to use some ratios. You should do some ratio analysis. Okay, to analyze that question of how the extent of effectiveness of the management in terms of managing the working capital needs. Okay. And that's what shall be discussing in this topic. Okay. So let's go simply to the introduction. Before we discuss each of the management of the components, okay, we discuss an introduction. Simply introduce ourselves to what we call working capital management. Okay. Where are my notes? Okay, allow me to get my notes. I still want to get them here. But they're here. What's happening? Yeah, here we go. Okay, working capital management. So is a symbol of this particular introduction. This is a simple introduction towards working capital management. First, I think we have defined that the working capital, technically, we can define it as the excess of working capital, the excess of current assets over current liability. That's referred to as the net working capital, the excess of current assets over current liabilities. Okay. However, it comes to define as the working capital to be the funds available or the funds the company requires, okay, in order to run the company day-to-day operation effectively. How much money do you need to be able to pay for the employees, pay your suppliers, okay, pay for the raw materials, okay, pay for the rent, pay for electricity, the cost of utilities, okay. So generally, okay, how much money do you require in order to have your day-to-day operation running smoothly, running effectively, okay? They'll refer to as the working capital management, okay? Working capital is that fund that you need, okay, in order for you to have your day-to-day operation running effectively, okay? Now, when it therefore comes to working capital management, okay, you want to ensure that the funds you have, okay, the funds you need, okay, the excess of current asset or current liability, okay, it is utilized in such a way that it is able to achieve the objective of working capital, that is to make profit as well as to be able to remain liquid. Okay, there's a purpose you want to achieve through working capital management. Okay, that's what we want to achieve through the working capital management. To be able to, at the end of the day, okay, at the end of the day, you can be able to make profit from your investment. At the same time, you do remain liquid, that you can pay for the obligations as and when they fall due. You can pay for the obligations as and when they do fall due. Okay, that's on the working capital. Okay, so don't forget those two objectives. Okay, to make profit as well as to be able to remain liquid. Now, don't forget, working capital is an investment, okay, which therefore ultimate returns for the business, for the company, okay. It's an investment, okay, which means therefore you have to pay attention as the management of how much potential return are we receiving from this investment. What is the cost to the business of having this working capital, of investing our money in the inventory, of giving our customer sales on credit? Okay, so you do a cost benefit analysis. Okay, actually, in this topic, it will be more towards cost benefit analysis. Okay, compare the cost versus the return we shall be receiving. Okay, now don't forget, okay, the money that you'll be using to finance working capital is not your money. Someone has to give up that money. Either you're going to go to the bank and borrow money, either you're going to ask shareholder to finance working capital, okay, either from their own pocket or from the company past retained earnings. But either way, at the end of the day, okay, someone will have to, the company, you have to, in quote, ask someone to finance your operations, to finance the working capital. And at the end of the day, this person needs return. Okay, if you go to the bank to ask for overdraft financing to finance your operation, the bank will have to ask you, hey, I agree, I can give you money. However, this is the interest I'll be charging you. Okay, this is the interest I'll be charging you. Okay, but therefore, you as a company, you have to consider therefore, okay, how much cost, what is going to be the cost of us financing our working capital need? Okay, what's the cost of us financing our working capital need? Okay, and if one of the way is to look at it out, if you're going to go to the bank, they're going to charge you interest. That is an actual cost to the company, because every month you do pay an interest. Sometimes if the money came from shareholder, the cost might not be actualized. What do you mean by that? Shareholders might not ask or charge an interest of X%. Okay, they may not do that. Okay, because it's their company. However, at the end of the day, okay, don't forget this is the money you have used to finance working capital. Okay, could have been paid to the shareholder as dividend, but we didn't do that. Okay, so they had to forego, okay, that dividend, and the money is retained by the company. It does not mean that it has no cost. It has a cost. Okay, in this case, an assumed cost, but it still has a cost. Okay, with the cost you as a business, you have to actualize and determine what is therefore the cost of us using our own retained earnings. Okay, the cost of equity. Okay. So generally, as a company, don't forget, you have to be quite careful. You don't over-invest towards working capital. Actually, most often than not, we notice that the return you get on investing in working capital is very minimal. Okay, the return you get on investing towards working capital is quite minimal. Okay, especially in case you have more liquidity. Okay, cash in itself, in cash form, it earns zero interest. Okay, if we decide to invest in CDs, regular deposits, invest in T-bills, invest in commercial papers, then the returns is a bit higher, but still very low. Okay, the more the liquid an investment is, most often than not, it yields very low returns. Okay, an example: cash. Cash is a very liquid. Okay, it's the most liquid form of asset. However, how much do you get from it? Zero. Okay, so therefore, as a company, you have to determine, okay, between these two objectives that we are attempting to achieve, okay, between profit making and liquidity, okay, you have to strike a balance. You have to balance this objective, okay. If you pursue more liquidity, it means you're hurting your profit, okay, because as I mentioned, the more liquid you are, the lesser the return you make on your investment, okay, because cash make very minimal returns to the business, okay. On the other side, if you have to invest in, or rather, the investment that makes more money are the non-current assets. Okay, the motor vehicle you bought to supply goods. Okay, the machine you bought to produce commodities. Okay, that's where those are the machines, those are the investment that makes more profit. Which means, therefore, if you pursue more towards the profitability side of it, if you pursue more towards the profit-making side of it, what happens? Okay, it means, therefore, you have an excess investment towards the non-current assets. Therefore, what's happening to the liquidity? The liquidity is decreasing. Don't forget. Okay, because in case you have excess investment towards the non-current assets, it means you have very more liquid towards the current assets. Okay. So you can see that these two objectives will be in contradiction. Okay, they shall be contradicting each other. Okay, therefore, as the management, you have to pay attention to these two objectives. Okay, you have to sort of try to balance the objective because you have to make profit. Don't forget. At the same time, you have to remain liquid. Otherwise, you can be declared a liquid company. You can be declared a bankrupt company. Okay, so you have to strike a balance between these two objectives. And that means, therefore, in each of the components of working capital, we shall be managing. We manage based on these two objectives. Okay. Thus, these objectives are in conflict as maintaining high levels of cash, or that is holding cash holdings, will harm the profit. You make very minimal profit if you do have a case of excessive liquidity. Okay, well, low liquidity, but therefore you are trying to pursue more of profit. It may imply therefore investing more towards the non-current assets, which means therefore you have low liquidity. Okay, so the objectives will be contradiction. So neither of those objectives is better than the other. Okay, don't forget. Okay, they are both two principal working capital objectives which must be pursued. Okay, both at the same time. Okay, both at the same time. Here, question. Okay, no question. As I already mentioned, okay, don't forget you have to make an evaluation of how effective the management is when it comes to working capital management. And one of the analysis you can carry out, okay, is the use of the cash conversion cycle or the cash operating cycle. Okay, the cash conversion cycle or the cash operating cycle. Now, what's the difference? Look, what is the cycle itself? Now, the cash conversion cycle indicate to us, okay, the time period or the time difference when the company in quote is out of money, okay, when you don't have money in quotes, okay. Uh, why do I say that? Because the cash conversion cycle is the time difference from the time you paid your suppliers, the time that elapses between payment to suppliers and cash collection from the customer. Okay, that time difference is referred to as the cash conversion cycle. When do you pay your supplier? In day 10. When do you get money from the customer? In day 50. What's that time difference? It's 50 minus 10 to give us 40 days. Therefore, was referred to as the cash conversion cycle. The time that lapses between paying suppliers and getting money from your customer. We'll call the cash conversion cycle. What do you mean, therefore, if the number of days, if the days are increasing, last year there were 40, the cycle last year was 40, and this year it's 60, what does it indicate? Is the management becoming efficient or inefficient? Last year, the days were 40, the cycle was 40, the cycle was 40, this year the cycle is 60, it has increased. What does it indicate? Efficiency or inefficiency?
Efficiency.
Sorry?
Become more efficient.
The managers are more efficient.
Yes.
Okay, let me give you an example with you. If, for example, let's see, if there's doing this, if I don't know, your guardian or your parents, they used to send you money every 10 days, but this semester they send you money every 30 days. Where can you deem them to be more efficient? The 10 days or the 30 days? Brian, use that simple analogy.
10 days.
10 days or 30 days?
10.
10 days, of course, 10 days, okay? The same applies to a company, okay? That in case now you're taking 40 days, last year you were taking 40 days to get money for the time you paid, okay? This year you have 6 days, then of course that is an increase in management inefficiency, okay? That is more towards inefficiency. You're becoming more inefficient if the days are increasing, okay?
I had 60 to 40.
Oh, you had 60, it's 40 to 60, it's 40 to 60. Okay. Yeah, no, that's an indication of inefficiency. If the days are increasing, that's an indication of inefficiency. Okay.
Sir?
Yes.
Question. So can we say that the cash operating cycle is equals to the cash outflows minus the cash inflows?
Not necessarily, because it is days now. These are days. Okay. These are days.
Oh, okay,
yeah.
Okay.
Yes, it's okay. In case if you're, let's say in case you are to hypothesize, okay, that you can convert the days into cash. Yes, it's true. If you can convert the days into cash, but of course, that's not here. So this is a days, okay.
Okay, I get it.
So let me show you how to get the cycle. Okay, let me show you how to get the cycle. Now you must see that the cycle is given us. Assume, let's take the case of a company involved in manufacturing. Okay, company involved in manufacturing setup. This is not a service company, they manufacture. Okay, assume that in day zero, okay, what do? They buy raw material. Okay, so this is day zero. Okay, so 0 day. So this is raw material purchase. Raw material purchases. So in day zero, buy raw material. So this is day zero. Okay, then we don't, or this company doesn't start production immediately. Okay, the material are kept in store for, let's say, 5 days. Okay, so in day 5, that's when production starts. Okay, like this is start of production. Start of production. Okay, then they don't get the finished good immediately. Okay, the conversion of material, okay, to a finished goods takes some time, and assume it takes 6 days. Therefore, in this 11, now here you have the finished good. Okay, so in the 11, that's when the production stops, okay, or ends, and the company has the finished good. Okay, assume that the company, okay, they have to transport the good from the factory to the shop, okay, or to the retailer, the supermarkets, okay, and assume that there's a 4 days difference between the time the company finishes the production and the time that the goods reaches the customer. Okay, this is where when the sale is made. Okay, there's a time difference between the time that we finish the goods and the time we deliver them to the customer. Okay, or to the retailer. Okay, for example, we have 15 days. Assume that the sale is not made on cash but on credit. Okay, which of course going to be the conversion case. Okay, for most market they don't buy, they sell. Okay, they may be selling, okay, to the customer, or they do sell to the customer on cash. Okay, but they necessarily, okay, for other company, okay, for if you're involved in manufacturing, you sell to this market on credit, isn't it? They don't buy on cash. Okay, for most market, for most retailers. Okay, they don't buy on cash. Okay, they're going to buy from you on credit. So you as a company involved in manufacturing, you make a sale today, you don't get the money. You don't get the money immediately. Okay, you get the money, for example, in that day's time. Okay, therefore, in day that, for example, you get the money. So 15 days later, so in day 30, that is 15 days later, that's when you get the money. Okay, therefore, this is the receipt of cash from the sale. Okay, assume that in day zero, the materials you bought were on credit. Okay, you also as a company, you have agreement with your suppliers that they shall be supplying to you on credit also. Okay, therefore, the agreement is that you pay them in the, let's say, which day? In the 8. Okay, so you buy in the 0, you pay in the 8. Okay, this is the 8th day. So here is payment to suppliers. Payment to suppliers. That's when you pay them their money. Is that clear? Okay, hope my analogy is making sense. Now you are saying that the cash conversion cycle is the time difference, or the time that elapses between payment to suppliers and the cash receipt. This is what we're calling the cash conversion cycle. You paid, and this is when you're receiving. Okay, this is therefore called cash conversion cycle, or the cash operating cycle, or the working capital cycle. Okay, or simply operating cycle. Okay, or simply referred to as the operating cycle. Okay, the time difference between the time you pay to the suppliers and the time you get money from the customer upon making the sale. Clear? Question? Okay, that seems to be clear. Now, in this example, for example, we can say that the cycle is 30 minus 8 to give us therefore 22. Then we can say therefore the cash conversion cycle for this company is equal to 22 days. Okay, is equal to 22 days. Okay. Now, between day 0 and the time we start production, that is when the days for and the materials are in store. Okay, we call it the raw material days. It's called the raw material days. Okay, let me just call it A so that I don't to have my work a bit neater here. This is A. Okay, we see that A is what referred to as the days for raw material, or raw material days. Okay, which is 8, which in this case is 5 days. Okay, let me just call it 5 days. Okay, then between when we start production and the time we have the finished goods, what do you call this, by the way? This time difference here between production and when we have finished goods, what do you call it? What do you call it? This 6 days here.
Work in progress?
Work in progress days. Okay, it's called the work in progress days. Work in progress days. Which in this case, for example, is equal to 6 days. Okay. Then for the time we have the finished goods and the time we have the sales, you make the sale. Okay. Between this is B, this is C. Okay. Between the time you have finished good and the time you're able to make a sale to customer, what do you call that? What do we call C? It's called the finished good. It's called the finished good days. It's called the finished goods days. In this case, which was equal to 4 days. Okay, which is equal to 4 days. Okay. Now, between the time you make the sale and the time you receive cash from the customer, okay, let me call it D. What do you call that? From the time you make the days for receivable, yes, it's called the days for receivable or debtors days, receivables days. Okay, which in this case we have 15. Okay, sum total to give us, of course, therefore 30. Okay, that is 5 plus 6 plus 4 plus 15 to give us, therefore, the that you have here. Okay, that you have here. Then we minus 8 because that's what we did. It was 20 minus 8. Okay, minus 8. Now the question is, therefore, what is 8? The time you pay, you buy supplies from the customer, from your suppliers, to the time that you pay them. What do you call that? That should be easy. It's called the payables days. We less payables days. So E minus E, payables days. Okay, less payables days. In this case, they were equal to 8. Okay, and therefore, 22 will be our cash conversion cycle. Okay, which simply means, therefore, the cash conversion cycle is equal to days for material, X, days for work in progress, X. Okay. Okay. Plus the days for finished goods, plus the days for receivable, minus the days for payable. To give, therefore, the cash conversion cycle. Clear? Clear? Question? Okay. Okay, no question. Let's do an example from the examiner. Okay, take a note in case you want to. Question on the cycle. It was very clear. Okay, let's therefore do an example here. For the cycle for this example, What do you get? That's to be the cycle.
So 77.
It's 7 days. Okay, let's do it together. Now, don't forget the days will be equal to the days for raw material 21 plus the days for work in progress 14 plus the days for the finished good days 28 plus the days for receivable 56 minus the days for payment, the payables days 42 days. Okay, and we get therefore 27 days to be the cash conversion cycle. Okay, very easy. Clear? Now, generally, if a company is not involved in manufacturing, they don't manufacture, which means therefore they don't have the day for raw material, they don't have the day for work in progress, they only have the day for they don't have the days for finished good. Okay, that is in case the company does not manufacture. They do buy already manufactured products. Okay, therefore they won't be having the day for material, day for work in progress, and the days for finished good. Okay, they won't be having these two. Okay, but they'll be having only the day for finished good. Okay, which means therefore, if a company does not manufacture, then the total day for inventory is simply the finished good. Is that clear? If the company does not manufacture, the total days of inventory is simply the finished good days. If a company does manufacture, like in this example, the days for inventory is 21 days plus the 14 days plus the 28 days. Is that clear? Okay, that's how you therefore you do get therefore the days for inventory. So in case the company doesn't manufacture, don't try to look for day for raw material. They won't find it, okay? Because this company is not involved in manufacturing process. Okay. Now, generally, okay, of course, quite unlikely you'll be having a case where the days are given to you. It's you to calculate the number of days, okay? It's you to get the days for receivable. It's you to get the days for work in progress through the use of formulas, okay? It's you to get the days for finished good, okay? So these days, you'll be the one who will be calculating them, okay? And of course, giving back the feedback, okay? Tell me, therefore, how are the 15 days calculated? It's you who will be doing that, okay? Most of the time, okay? I think we can do the formula, okay? Let me go back to my writing pad here. Yes, okay. Now the question therefore, how do we get therefore the days for material? Okay, the days for material are given us material days is equal to the raw material investment, that is the amount that the amount of raw material the company holds at any point in time. Okay, we divide by the total purchase in the year. Therefore, total purchases of material, total purchases of raw material times 360, 365, whatever it's you want to use, or given by the examiner. That formula therefore give therefore the day for raw material. Okay, raw material divided by the total raw material purchases for that year. Okay. That's for material. Then we have work in progress days, given us the work in progress investment, the amount of work in progress the company holds at any point in time during the year. Okay, we divide by the cost of production, the amount we're incurring to produce the work in progress up to that point in time. Okay, cost of production, we multiply by 360, 365 days in a year. Then you have the finished goods day, given us the amount of finished goods the company holds at any point in time. Okay, if you're to go and do a stock take, how much of the finished good can we find at any point in time? Okay, finished goods investment. Okay, we divide by the cost of sales I hope you can see how it's progressing. From purchases, we had raw material here, we had labor, we had some other indirect material. Now here we are about to sell the goods, so we add on top of the cost of production the selling cost. Okay, we multiply by 360, 365 days. Okay, then the days for the receivables days given us the days for receivable, the amount we invest in a customer, the amount of goods on credit the customer owes us at any point in time. Okay, the receivable investment or debtors investment, we divide by the sales that were made on credit the entire year, credit sales. We multiply by the 60 or the 5, and finally the day for payables days given us the payable, the amount we owe supplier at any point in time during the year. We divide by the purchases made from them on credit. CL means credit purchases, or conventionally we use the cost of sales. Okay, cost of sales times 360, 365. Okay, and that's how we get therefore the days. Okay, don't forget, quite likely what will happen is that you are the one who is going to get this number of days. Okay, therefore it's all enough you know these formulas. Okay, clear? Okay, enough. If there's no question, then I guess we can air the class there. We meet at 2:15 for our class. We meet 2:15 for our class. Okay. So yes.
Could you please explain raw materials days again?
The case of raw material days. Raw material days. Okay. What we want to determine is between the time you buy raw material and the time you start production, what's that time difference? Okay, because the raw material days, and it's given us the amount of raw material we have in store at any point in time. We'll call the raw material investment. Okay, we divide by within that year, what the total materials we have purchased. Okay, total material purchase in that year, we multiply by 360. Okay.
So for receivables days and payables days, the credit sales and purchases are the total credit sales and total credit purchases.
Yes, during the year, the total sales made on credit and the total purchases that have been made on credit throughout the year. Yes.
Okay, thank you.
Yeah, but most of the time, okay, because the financial statement given to you, it's quite hard for you to get this figure. Okay, the purchase made on credit. So what do? We use the cost of sales. Okay, because quite unlikely are you going to find a figure that gives you the credit purchases. But in case you have, then use it first. Okay, but quite likely you won't find it. That's why you normally use the cost of sales here. Okay.
Okay.
Good. Okay, fair enough. Then we can meet at 2:15 for our second class. Okay, and we shall do an MCQ. Okay, for the first topic. Okay, a very short one, just to gauge on how you're able to understand that first topic. Okay, then see you at 2:15.